Hello, everyone. Um, Welcome back. It's been a busy week, of course, with the ETF opening up and getting everything squared away with that. It's quite a little project. And we have 171 positions on, or 170 or something like that, 169. Anyways, I don't think we're quite finished. It just takes a while. Markets are closed and opening. Singapore, Malaysia, South Africa, we trade some markets there. Brazil, yeah. So Europe, they got a late start. So it's been fun, and I won't be satisfied till we get them all on and we, get going full speed here. But it's kind of fun, and you can see the positions every day at the website. So yeah, it's been a uh, big week in the markets with the dollar. That's been interesting. Um, I think I was mostly short with a few stragglers behind. Still got some longs, but dollar looking bad and rates looking a bit stronger. Stocks looking good, and we have some stocks, some longs and shorts, and yeah. So yeah, I particularly wanted to get into the podcast. I've listened to Richard's podcast with Niels a couple of times. A lot of good stuff in there about diversification and multiple systems. I didn't have the time to tweet all my favorite parts like I normally do. So hopefully I'll get around to that over the weekend. Um, as I said in one of my tweets, I wait for Richard's appearances on these podcasts like I'm waiting for the next episode of Secession, love Secession. And Richard never disappoints with all of his insights and wisdom. I wish I was on there with him, though, because, he's more of a gentleman than me. Um, but anyways, it was really, really good to listen to diversification. So get ready, Richard. I'm going to talk about diversification, the different ways that outlier hunters look at it, the multiple systems, and oh yeah, your co-host was interested in talking about different systems, different parameters, and maybe even different weightings for the markets. That was interesting. And I made fun of that idea on my tweet. Oleg, how are you, buddy?
Hi Jerry, hi Brian, hi Richard, hi Bruno, Mike, hi Michael, hi Alp, hi Jerry Smith, and all the other guys, Mbala, and all the other guys I see here. I'm very glad to see you all every week. I'm very glad to be here every week and very happy to be here every week and say this all every time I'm here. And almost every time I'm here, if I have no very big technical issues. So, because it's one of the most important thing, our discussions is in fact one of the most important things for me, like trend following, like nature, and some other things. So, I want to say that this week I was impressed by podcast with Richard and Niels. Really, I love this scientific approach, and I often say that our trend following world is not separate from the the other world, from the laws of nature. It's not something that is separately living separately. So, and for me, it's a big evidence that our approach is a great approach. So we saw this in physics, and by the way, I have read a book It was a present for me, a fiction book. Usually, I don't read such books from Chinese writer, and it was about scientists, and there was the same things I have read there. I was reading it in winter, in February, and the same things that Richard said, the same things. So it's a very high valued scientific approach uh, in Richard words, and really very impressing this. And I'm always impressed by Jerry's interviews. Every conversation with Jerry I have listened, and I think every conversation with Richard, because also it's really wonderful also. So thank you. It was great.
Hi, Josh. How are you?
Good morning, Jerry, and thank you for the great new ETF. So exciting to watch the time and sales as that thing didn't, and then took. And then I was happy to get in, as you know, right at par. I think one of a few people who were at par. So I'm pretty happy. And then my wife got in, and fractional, yeah. She was able to get a dollar amount in versus just a pure set of shares. Love if you would talk about what's possible for that ETF in terms of AUM. And in terms of Richard's appearance on Neil's podcast, I love Richard. And every time I hear him speak, I get smarter. And so I have to listen to him slower at 0.8x or 7 sometimes. Side note, when there's heavy accents like Mulvaney, I have to slow it down so I can hear it better and understand it. But I heard the whole thing, and then I heard it again at like 1.5, and I'm able to follow, and it was just great. I also have my single stocks results, which I will post in the Twitter as usual. I'm up to 581. But here's the great part, Jerry. 16% on the open equity on 581 single dollar entry fractional shares in the single stocks. No pyramiding, just one each. It's really fun to play. Thanks.
Yeah, I agree with all of that. I had to laugh about slowing it down. But yeah, the accents, there's so much good TV coming out of UK, Australia, and I have to listen to I have to watch the captions. So there are captions available on YouTube sometimes, and then I have the transcript doesn't get as fooled as I do as it relates to the accents, Mulvaney and Richard. But yeah, you got to slow it down and listen to it multiple times. You learn a lot. Um, I think the AUM, hopefully it'll, continue to increase. And I mean, I don't know. It's a different type of strategy. One, I really enjoy all the comments, and thank you everybody for the support on Twitter. Uh, so everybody is kind of most of the people commenting kind of know what's going on, but there was one kind of comment, which is the obvious kind of comment, which is like it's the managed futures. They've been programmed, and part of it is they kind of know better, but it's the marketing stuff, and so they pretend not to know better. And that is one person commented, only one. I mean, but no big deal. I'm just saying is most of the people who are interested kind of know because they try to, when people listen to me talk, they speed it up. Let's get the hell over because it's the same thing all the time. And a couple of my friends have told me that recently. Like I went back in time and listened, and you've never like you have the same message for the past 20 years. You just keep repeating it. I'm like, yeah, but so anyways, the one person wrote in on Twitter and said, "Why are you trading so many stocks? When I already have stocks in my portfolio." And like, yeah, that's exactly right. That's the radical part of the whole idea, which is, but they're not being trend followed. sell your stocks, sell your bonds, because if you have something in your traditional portfolio that's long only and you're not trend following it, then you're going to have crisis. And so maybe if we trend follow these stocks and bonds, we have less crisis and less need for crisis alpha. And the trend following will, with the stop loss and trailing stop, will get us in and out a little bit better and safer in the diversification. So we can break this whole idea of I have my stocks and bonds and I'll allocate 5 or 10% to manage futures. So yeah, it's just going to take a long time for people to, or for anybody to kind of gravitate towards that radical idea that we should be trend following everything and break this stranglehold that managed futures has over trend following. And I'd love to bring up the distinction between trend following and managed futures, two entirely different things. So I appreciate that, Josh.
I love seeing your holdings list. It's great, especially the stocks, big gun and big potato chip. Thanks, Jerry.
Oh yeah, we have some guns and some weapons. Yeah, I mean it's all kinds of fun stuff out there. Krispy Kreme. I told you, you got to have fun. And if you scroll down that list of stocks, it's got to make me smile. It's got to make me enjoy life a little bit more. But it's all about the diversification and small companies, smaller, 10 billion. Not everyone is 10 billion and below. The longs are not. Maybe have a couple that are a bit above. But it's all about hunting that outlier, maximizing that diversification, and choosing 300 markets and massive diversification. So you're allowed in a robust way to let the profits run. So with 60 markets, you're going to feel compelled, as they do, to cut profits short, massage the equity curve due to volatility, correlation changes, volatility changes, and whatever changes that they come up with. And this just sort of gives you more of a chance to trade the classic style, but we're really cheating with all these markets because it's really difficult. It's certainly possible, but it makes it harder to have really bad periods and really good periods. It's just more steady as she goes. Hello, Richard.
G'day, Jerry. G'day, everyone. Look, I've been fairly quiet this week because I've been away, but I've sort of on the way back this afternoon, I was trying to catch up with everything. So, seen a lot of activity on Twitter, but unfortunately, I haven't been able to participate. But I hope all is well. How are you, Jerry?
I'm doing great. I'm very busy, and everybody's been very busy working with different groups of people. It takes a lot of people doing different things to make it all happen. So we're getting used to the ETF world. With trend following, when you start out with the futures, it's a bit different, and so you start out kind of, in my opinion, a little bit more complicated than stock only. And so as you move towards stocks, which is a little bit easier, you just kind of pick it all up. But when you deal with people who are stocks, and then you have to sort of work on the futures and the forwards, and it's a little bit of a learning curve to get everybody up to speed. And then we need to learn the ETF world because we're told. I'll sit in meetings and I'll repeat things over and over. Like I have a tendency to repeat things to people because I want them to say, "Oh, you don't have it correct." But I would get in meetings and repeat what I think is going to happen on day one and day two. And they would just let me keep repeating things that were not true and not accurate. So when day one and day two got here, I was like, oh, okay, I see what we're going to do now. So it was a bit easier than I had dreamed up. But it's, watching that price, watching the volume, it's taking time away from my Twitter app. I'm focusing on this thing. It's kind of funny when you have something like this. I'm sure it'll get I'll be able to put it aside pretty soon. But right now, everyone's life is dominated.
We talk about maybe the same things, repeat something again and again, but it's every month, every new conversation, I'm getting a little bit smarter in trend following space, I think, because really it's very deep topic, and I love trend following for many years. I have listened to a lot of podcasts, a lot of conversations with Jerry, with Niels, with Richard, with Maurice, and every time I listen it, I feel something new. I don't know, it's a phenomenon, but I feel something new, something great. Every time I do a back test, I feel excited. It's very exciting. It's very interesting. So it's very, very deep and interesting topic and philosophy.
Well, see, I think it started on, let's see here, Wednesday. And then Thursday was a lot of activity, or maybe Tuesday. Wednesday was activity, a lot of activity. Yesterday was a little bit of activity. And then we'll see what happens today. So, yeah, it just takes a while to get everything going and all the positions on. And literally, we're competing against Andrew. And I think there's two really great choices here. It's 14 markets. And, Andrew has 14 markets and he always has a position. So I have 300 and I don't have a position in every market. And in some markets, I don't have a full position because I have multiple systems going. So it's really two different strategies here. I do think Andrew and I will offer a good choice. You've got the SocGen managed futures, CTAs, the top 20. Hopefully he can continue to do a good job replicating a lot of vol management, correlation management, good diverse portfolio. In some respects, it's trades coming and positions coming from 20 managers versus my one, we're just one manager. And so it's a very good choice that people could say, okay, that's managed futures. This is all the latest and greatest correlation vol management risk overlay. And then Andrew does that with 14 markets, always having a position. And then you have something very, very different. Lots of stocks, 300 markets, multiple systems, but not nearly the the level of diversification system-wide that Andrew gets in the SocGen 20. Of course, some of the system features in there I would not want to have, of course, because what we're doing is more pure trend following. So I think Andrew and Chesapeake, it's really going to be two good choices. And I think one of the things I remember, I believe Niels mentioned this in a podcast or maybe an email, but I think he said something like, this is the first time, other than Andrew, I suppose, but this is the first time a CTA has created a mutual fund or an ETF with the fee is around 100 basis points in the ETF and 150 or so in a typical mutual fund. But the first time that a CTA has ever created an ETF or a mutual fund, and it wasn't kind of a watered down product, where the CTA had the good program with all the bells and whistles at 2 and 20 or 1 and 20 or 1 and 15, and then, okay, we'll do a mutual fund, but it doesn't have all of our best ideas. So we have all of our best ideas, and this portfolio will be almost 99% what I have in the private fund. Now, the private fund will have other things going on to make it worthy to invest in as well, but We have not watered this down. And I get a lot of tweets from people like, please don't water this down. Please make it like you said you were going to make it. So, of course, I'm going to do that. I've been preaching for so long about how wonderful all this is, and I'm not going to create something that's not my best idea. I just, in order to be able to upsell on something else. So that's pretty interesting that it's working out that way. So I think Andrew and I, we're going to offer two good products and for everyone to invest in. It's really fun too. When your kids are buying and their friends are buying, it's just kind of like funny, and all my Twitter friends, they think, they're really happy. So it's been a fun little project. Just got to keep it going and keep the interest up. And yeah. So if you have any suggestions and stuff, what you see out there, let me know. And any questions, people were questioning what's going to be in this fund, and it's the positions are readily available every morning. I'm looking at them now.
Hey, Jerry. Hi, guys. Jerry, what is going to be the drawdown profile and the leverage profile of this ETF? Thanks.
Well, it's going to vary over time, but I think this is going to have like a volatility of about 15% or so, something like that, targeting, upper teens on average. The markets have been so quiet recently. It's kind of a strange period where I was wondering if my diversification was too good because my other funds just not moving around very much. But everybody is, I think, feeling the same thing. It's just not a lot moving the markets. Everything is diversification's kind of working, but we don't have anything crushing it. And other than Mulvaney, which I can't figure out. But it will be a fund that is suited towards its target and towards the person who wants the perfect portfolio of trend following all the different markets, especially the stocks. And so it won't be, some CTAs do a very good job, I would say, like Dunn and Mulvaney, of truly being something that can have outlier performance, like 50, 60%. And really, if you do allocate to those guys, you just a small, like 5, 15%, they can really have a positive impact on your portfolio during the drawdowns in the stocks. And then most of the CTAs, though, don't go for those higher returns. But so we're going to not go for that. So we want people to be able to hold it long term and like it and not really have to think too much about it. And that's how I want to, and it's going to be ultimately what you're banking on, what the ultimate thing that is the best part about this whole fund is that it's all me. It's all about me. It's my ideas, my risk tolerance. And so I'm giving you what I think is perfect for me. And so, some people will say, well, I don't like that. You should do other things. You should trade larger, smaller. You should add those other things. And that's perfectly great. But that's your ultimate, do I have skin in the game? I absolutely do. I have skin in the game and I'm not charging an incentive fee. It's totally reasonable because I have all of my, the vast majority of my savings and money in all of these products. And so that's what you're banking on is, okay, and I can screw up and make a huge mistake, but just know that I'll suffer as much or more than almost anyone.
Hi, Jerry. Can I ask you a question? Did you have to kind of formalize the method of selecting the stocks that you are able to trade, or that's something that doesn't have to be formalized for the purpose of being on an ETF?
No, I didn't have to do that. I just it's a active or discretionary type, actively managed. It's not based on an index. So many years ago, when I let's say 10, yeah, like 10 years ago or more, I explored the ETF wrapper, the structure, and we tried, and there was really no um, actively managed ETFs out there. And I was working with people who were very, from the very beginning in the industry, and we were trying to figure out a way to sort of create kind of a trend following index out of what we were currently doing, and call it an index, but it would be, obviously active trading, daily changing positions daily. And the SEC rejected that because they really weren't allowing any of that to occur. So now that that's wide open, and it's probably the majority of new ETFs now, you don't have to formalize anything. There did seem to be this is, I think, the first ETF, because, as I told you before, we were told by industry veterans that we could not do this. And this was not possible. They shouldn't have told you it was possible. I don't know why they told you it was possible, and you can't do this. And then we went to our partners and we told them, quote, verbatim, exactly what this person had said. And they said, oh, yeah, we know him. He's a friend of ours, but he's wrong. We can do it. And it is a lot of futures and a lot of stocks at the same time. So I don't know if there is an ETF out there. There are ETFs that trade stocks and a couple of futures, like a lot of them, because they're trading, they're hedging the currencies or something like that. But 150 stocks and 150 futures, I don't think there's any, not as far as we know. We've never seen anybody do this. There was no example of it ever being done. And, the problem is the market making. You have to find the market maker who can handle futures and stocks and all these different exchanges and non-US exchanges, futures exchanges as well. So it's quite a big feat, but we haven't pulled it off. We have to have a good bid offer. We have to raise money. If it doesn't work, they'll just say to me, "Oh, sorry, we thought it would work." Right? That's what they'll say. But so hopefully we can pull it off, and it'll be a big, huge success.
And my guess is that it has to grow in terms of assets under management to have proper position sizing, or now it's already in full position sizing in terms of the diversification and etc.
Well, it's pretty good. I mean, we don't have issues with forwards or stocks, but some of the futures contracts, because we're trading this, it's a small fund and we're trading it conservatively. Yeah, we have some issues with rounding, but over time it will be a full-fledged with all the absolutely perfect correct positions on. But yeah, to begin with, maybe there's like we're long Bitcoin and Ether futures, and I don't know if those are big contracts. So I'm not sure we're going to have that on until we raise more assets. Those those two futures contracts, because they're so large. So maybe when we run it through the computer with this asset base currently, maybe each one of them gets a third of a contract. So we have, that rounds to zero. But that's kind of rare. There's probably just a few markets like that out of 300 and some. So, but over time, and it's in my best interest to get rid of that feature as soon as possible. And we have a big infrastructure built around this fund of raising assets and supporting it. And so I don't think it's going to be too long before we have every single position on just the way it should, with hundreds of millions of dollars. Oh, one other thing I wanted to mention was that I said something earlier. I wanted to draw the distinction between the full-blown program, the best program we have to offer in a ETF wrapper, there are mutual funds out there like Eric's that have his full-blown program of managed futures program combined with sort of a permanent long stock ETFs. So that's that's good. That's a good product. He's done really well, and so I wasn't 100% accurate in that regard. But once again, it's long worldwide stocks, 50%, roughly 50% of the assets, and the other 50% is the managed futures program, trend following program. But once again, the distinction here is the stock weighting, the 50% stocks is not trend followed. It's just long only. And a funny story, about, I don't know, 5, 6, 7 years ago, I was up in New York and I had breakfast with some of the guys that are working with Eric, and they had this idea of doing what they're doing, and I'm like, you should change it, and you should trend follow the stocks, single stocks. And they said, nope, we're not going to do it. And I said, well, you should do it. And so fast forward 6, 7 years, I'm finally doing it, and they're continuing to do what their vision was, and they're being very successful. I love the competition. My wife is like, you just like this because you want to win. Like, I know. She's like, you're like 12 years old. Why do you have to win? Why do you have to put yourself in a situation where you can fail? Just go along, get along. Like, I know. I can't do that. I just have it in my head what the perfect thing is for trend following and for me, and I just have to do it. And I won't be satisfied. And it's really not, for some reason, I just have that as a personality flaw. I'm just always trying to make this a little bit better. And can you believe it is taking me this long? And that's what's so disappointing. I think we've made many good decisions, and everything about me and all my decisions, you can see in these positions. If you want to study these positions, you will learn all you need to know about me. The markets that I trade, how I trade them, everything about it is me and my personality in my 39 years, coming up on 40 years of trend following. And I just, so this is what I have to do. And to give trend following the best opportunity to show what it can do. And I don't want to be alone, and there are others out there like Mulvaney who are showing that as well. But I'm not going to give in and give up to managed futures. We need to trend following needs to be on equal standing, with managed futures CTAs, and I think it can happen. But hopefully this is the first step, small step towards trend following dominating managed futures and dominating asset management in general. All right. Do you want to talk a bit, Richard, on summarize for us what you were saying to Niels, and I can ask you a few questions as it relates to the diversification, as it relates to how outlier hunters look at it differently, and then how the multiple system approach works and breaks up some of the correlations.
Sure, Jerry. So there were 3 key topics in that one I did with Niels. The first topic was about a medium to long-term models. Why a trend follower perhaps can or prefers that time frame. I was thinking of Alp while I was saying that, and I was thinking he's probably hitting the table as I'm talking about this, but I was just giving my personal opinion about why medium to long term is the area that I'm focused on, and that sort of was based on the principles of these asymmetrical open-ended systems that when you start at the lower bound, which is the tick, and you start accumulating more and more ticks, there's this what we call this destructive interference and also amplifications going on, which reduce the noise and amplify the signal, so that we see that these major trends start emerging over sort of medium to longer term timeframes. That was the first topic. And the second topic was about how we can use the system ensembles to reduce the level of correlations in our trade performance that we achieve in trading fairly highly correlated markets. So the examples I was giving was, trading Brent and trading crude, or trading London sugar and trading sugar, and how I was finding with this ensemble approach, the nature of the trade distributions that we achieved in trading those very highly correlated markets were significantly different. And this was these sort of small minor variations that exist in these highly correlated markets that are sufficient enough to create significantly different trade distributions and significantly reduce the level of correlations produced in the trade returns in the portfolio. And so I'm viewing this ensemble of systems as a means to be able to trade, or be less concerned with trading highly correlated markets, because the nature of the systems that I deploy break down that degree of high correlation. And that therefore gives two agendas. One is it not only sort of produces less correlated return streams, but it also allows you to therefore trade many more markets that previously were regarded as being fairly highly correlated. And the third topic was just talking about these transition events and these complex systems, these major regime changes which are being separated, or the stable regimes on either side of these transition events. It's the stable regimes where we get our convergent brethren focusing on and exploiting the predictable opportunities in these stable regimes. And these transition events are where these outliers tend to exist, which effectively totally disrupt the prior regime. So anyone trading with a convergence system that is looking for a particular predictable opportunity finds that opportunity is removed during this transition, and there's a total disruption of that prior regime to create a new regime, a different equilibrium. And in that zone of uncertainty is where our outliers lie. So there are those three core topics. So blast away if anyone wants to talk about them.
I have a question for Richard.
Go, Josh.
As I said, when you talk, I get smarter. So I want you to talk so I can get smarter. You said the tick is what's determining the bottom boundary. And what I assumed you meant was the buyer is crucial. No buyer, no trade. Can you help me understand that?
Yeah, so the tick is where the transaction or the price event occurs. So it requires a buyer and a seller, and then there's a matching process that goes on at the broker's level where they match the buyer and the quantity that the buyer is wanting, as well as the seller and what the seller's wanting. They match that process to create a tick, a transaction event. The consolidation of those ticks is what creates a price series. So it's a zero-sum game. You get this matching process going on. Now, over the course of time, if there is this dominant behavior for a particular model being deployed, so if there are a large group of participants who are applying the same models, over the course of time, that exerts a force, an underlying momentum to that driving impulse on the transaction events, which creates this bias, and then from that process, these trends start emerging. That's what I was meaning, Josh. Hope that clears it up.
Beauty. Thank you.
I had a couple of issues I wanted to delve into on this one. Let's see here. Okay, the big issue here is you kept sneaking in this special word. But we talk about this all the time on Spaces, but yeah, you kept sneaking in this special word, and I wanted to highlight this. and that is trade. Trade. So, yes, if and it kind of gets back to one of my kind of comments that I would make that sort of tongue in cheek, but just to be kind of contrary, um, I would sort of try to take the position that exits are not more important than entries. They're kind of the same in importance, and the only reason that exits are could be thought of as more important than entries is because a lot of the exits are going to come after you've made a lot of money on a certain trade. And System 1, which is just a bit different than System 2, for instance, a bit shorter term, it's going to get out quicker. And on some of these trades, getting out a bit quicker after you've been in it for a year or two, and it's made 100 ATRs, and it's very volatile, and you haven't cut it back. The difference between System 1 and 2 exit, when you put the trade on, could be like nothing, zero. It's the same exit, not the trailing stop. But once it gets going, and it's been this big, huge trend, then when System 1 gets out, it could get out at this great price, much higher than System 2, assuming a long, or it could screw up totally because it got out too quickly and the trade kept going. And so in that scenario, these big trends that are dominating performance, then on any one individual trade, the shorter term can be much better or much worse, or certainly can be very similar or the same. But only if you look at it from the trade P&L point of view. And the managed futures people will say, well, we don't look at it that way. We look at Sharpe. We're obsessed with the daily equity. We correlation and vol manage, for God's sakes. So we only care about the correlations as it relates to the daily equity changes. And a lot of these markets, like crude and Brent, they are the same every day. And we're not going to wait until the trade P&L's out and say, oh, I made 50 ATRs on the WTI and 100 ATRs on the Brent because one of my systems got out quicker or slower in those two different, just a little bit of difference in the price pattern that allowed one system to have a much different P&L than another system in another market. And so having this diversification was really great, trading these both seemingly highly correlated markets and these seemingly highly correlated breakout systems, but they actually yielded one of the other, or in a combination somehow, this much different P&L. That whole concept is totally rejected by managed futures people. We don't pay attention to trades. We don't care about sample size, one entry, one exit, and a stop loss. All we care about is this equity curve. We're massaging it. We're cutting profits short. We're adding to positions in the middle of a trend or towards the end of a trend. We're subtracting. We're doing massaging the positions daily. So it's all about, so for Richard and me, it's all about this trade. And for all those reasons, and we'd love to trade all these markets. We'd love to overlay these markets with multiple trend following systems. But it is strictly classic trend followers, one entry, one exit, and a stop loss.
That's exactly right, Jerry. The reason I was focusing on this word trade was to get into people's head that when they talk about correlated markets, what they're talking about is the price data. Now, look, everyone can talk about correlated markets, but really what people should be worried about is their trades. How correlated are their trade outcomes? Because we don't really care about the correlation of the price data itself. It's how correlated are our return streams from our systems that we deploy in that market. And that's what's important, because that is what's generating our P&Ls. It's our trade outcomes. So the ability of our system ensembles and the interaction, how our systems interact with that outlier, there's a twofold thing going on. There's this outlier that exists in the price series, and then there's the ability of our systems to exploit that opportunity in that outlier. That's what creates an outlier trade, the combination of both. And therefore, when you're deploying trend following systems, one entry, one stop, with our golden rules, and we have these slight variations of our trend following systems, we find that we can trade these highly correlated markets, but our trade results are significantly different because a single outlier in those trade results totally changes the degree of correlation in a return stream of one market against another market. And they're incredibly disruptive outliers, and correlations only measure a linear relationship between return streams. It's not looking at the magnitude and the difference in the price, the price returns between return streams. And so there is much more than correlation that's important for our results. There's the degree and magnitude of the outliers themselves, how there is this sort of relationship between prices and what is the magnitude of the difference created with our trade impacts. And so all of these other effects are what is totally excluded in the minds of most trend followers that are just dealing with correlations and these sort of things. That's why you and I say focus on the trades, because really it's the trades that are our bread and butter.
That's right. I was surprised at the end you got buy-in from your co-host so much. I think you tricked him with using the word trade. But and another thing too that Neil said, I didn't agree with, and I wanted to get your opinion on this. And it is, he said when you were all finished, he wanted to sum it up, and he said, well, in order to achieve what you're trying to achieve, you need hundreds, or I don't know, it was like some exaggerated number, hundreds or thousands of different types of trend following systems to achieve what you're trying to achieve. Okay, maybe that's not what he's meant to say or whatever, but I wanted to still explore that idea as it relates primarily to me, and that is, I see quite a bit of diversification with breakout only and 4 different sets of parameters. So and the breakouts are very brutal when they're very uncomfortable and not nice and sweet and clean like a chandelier or even a moving average. Because with these moving averages, they move up as you make profit, and you are always locking in profit. Sugar, cocoa, you're just locking it in. Every day it moves up, your trailing stop moves up. And breakouts, they just do not behave like that. And you can generate so much different P&L on the same trend. And that's every single day you come in, your systems are 100% correlated. They're all long, and you're making money or losing money on these big trends. 100% correlation. And then when the trade is over, you look at how it all happened, and your shorter term systems can have way different P&L. These breakout systems, the differences can be dramatic because just the way that they don't move up together, and they don't move up very, very quickly. And so now the back test that we've done, it shows that all of these parameter sets make the same amount of money over the back test, 30, 40-year back test. But in each individual trade, they could have very different P&Ls. And so I don't think it does take thousands or hundreds of different parameter sets or different types of trend following in order to, I don't think I need to add a chandelier, moving averages, and whatever else. I think I get a fair amount of diversification on the trade aspect just by, spreading the breakout exits over. They can't be too similar, but spreading them out over anywhere from 3 to 12 months or 6 to 12 months, something like that. And you can get. I don't think you need to come up with. But that's what he was trying to say. how labor intensive that would be and how hard it would be, but that's not been my experience. What do you think about that?
Well, what I gathered from Niels was that I think he was appreciating that a lot of trend followers do things differently. And I think his question posed at the end was, let's say that there are certain trend followers who are not simply 100% focused on these outliers. Let's say that there are trend followers who are also looking at different forms of trends, say that exist within mean reverting environments. And let's say, therefore, that they have this appreciation that there are outliers to catch, but there are also other forms of trend to catch. Now, I can appreciate where he's coming from there, because I've heard this on that mini series as well. A lot of the different CTAs are targeting different facets of trend. So I've thought to myself, oh, well, look, I'm an outlier hunter. I'm pigeoning myself. I'm classifying myself as an outlier hunter. I'm totally happy with that. I'm 100% outlier. But I do appreciate that there are other trend followers targeting other aspects of trend. So his question was, there will be some trend followers who might, for instance, start bundling up similar markets with similar characteristics, rather than having targeting these universal features across all markets. There might be some trends from the mean reverting character of markets. You might need to bundle up those markets to trade them a particular way. And you also might need these universal models to trade the broader sort of outlier, as we do, in another particular way, how would you do it? I think that's what he was getting at. So, I'm starting to get to a happier place where I think I've just got to pigeonhole myself as being distinct and targeted towards one particular aspect of trend, but just recognize that there are other trend followers focusing on different aspects of trend. Of course, I'm always going to be a favorite, of my particular approach or our particular approach, Jerry, with our belief that that's the best way to go. But I think I've just got to appreciate that there are other trend followers doing different things.
Oh, yeah. I think that's a good way of doing it. I remember when I first started trading in 1988, I would meet people at conferences who, or I was working with this one group, and they were raising money for CTAs and especially for us. And they would introduce me to other traders. And the one thing that I always would ask these traders that I would meet for the first time, I would say, "Are you a trend follower?" And they were like, "No, we're not trend following." And I'd be so happy. Yeah, I'm like, "Cool, I'm down with that." So you don't need to look over here. There's nothing going on. You don't need to compete with me. And so, as much as I like to have fun debating these issues with people here and Niels and other people, it would be kind of a nightmare that everyone wake up and say, "Oh, guess what? Jerry's right. Let's start adding a lot of stocks and trend following and letting profits run. He's right." And I'd be, "Oh my God, why did I have to say anything? This is ridiculous. I don't want you to all copy me because I have this new ETF. I need to have something that different that no one else is making, selling." And however, I will say that I don't really agree inherently with that idea, and I take a more extreme point of view on it. I came up with this kind of rude way.
You could be like Harold, Jerry. You could be like Harold. Remember that episode with Harold where he said every trend follower should be different, and he doesn't like the fact that they're too similar.
Right. Of course, and that fits right in with the managed futures idea, which is, everything is great. Everything's great. Just embrace what you want to do. As long as you like it, that ipso facto makes it correct. And I'm like, that's bullshit. I don't like that. And I do think that some errors that people make, including myself, and I've made errors, and I have recognized those errors over the years. Some errors are more consequential than others. And some errors do not show up for many, many years. And so my rude and negative way, and kind of trying to be a little bit funny as well, that to sum up this, the way I think about it is quite the opposite of what you guys were, Niels was saying on the podcast. And Niels listens to all this Spaces stuff, and he and I debate this. The thing about Niels is that he's the one person that I can have these debates with regularly, because we have a tendency not to really agree, and there's no one else who will engage me. So I'm kind of forced to listen to, which I love those podcasts. And I am on my treadmill almost all the time when he says, hey, we have this friend who's not going to like this, and he's probably going to fall off his treadmill. And ironically,
You've got me laughing.
I'm on the treadmill like all the time when he says this. I'm like, how does he know? And so, however, okay, so I'm not picking on him, because he'll pay me back in one of his future podcasts, or if he has me on, they'll be hammering on me on this stuff and never agree
They're
with me.
preparing their landmines now. You know that, don't you?
Right. That's right. And so here's my rude way of summing this up, contrary to what he said, which is that trend following these markets is so powerful. Getting in gear with these trends and paying attention to price, and having a good diversified portfolio of currencies, commodities, stocks, bonds, long and short, is so powerful that no matter how managed futures screws it up, they still can't prevent themselves from making money. So that's what they're confused by. And I'm going to go with one of his guests from CFM, which is a very highly regarded firm. I'd say one of the most highly regarded advocates of trend following. And I had this as a pinned post on my Twitter for months. And he said, by their analysis, over 90% of the returns were due to trend following of the managed futures CTA. So they've got nothing to add to trend following, even though they add a lot of junk to it. And they can't even get it to a place where, with all the additions and all the ways of not letting profits run, not treating all the trades the same, not caring about sample size, not having one entry, one stop loss, and one exit, they still can't screw up their trading. Trend following is too powerful. Now, if you don't follow your systems, and if you trade too large, that's going to get you in big trouble, even if you trade really well, even if you have great systems. So they don't trade too large, and I'm sure they're incredibly disciplined. The typical managed futures CTA is probably incredibly disciplined. So that's kind of my comeback. And I was sort of surprised that that I did post a rude tweet about this yesterday as well, when I heard on the podcast that there may be CTAs who trade different systems for different sectors or markets. And that last piece that you brought up, Richard, I thought that was like, oh my God, so they're going to do that as well. More of this fine-tuning, optimization, all of which we're against. And I will say too that another really fun thing about this ETF project and all of this talking is that I fully expect, and it must occur, if we don't start seeing differences in performance of this classic pure trend following with all these markets and the typical managed futures, and if there is no real difference between these things, then I lose. Then everyone else is correct. It doesn't really matter how you do it. We're all here. We're all trend following. There's these rules we pay attention to. He did mention that. I don't know which ones he's talking about, but yeah. So if the rubber doesn't meet the road to where we have different performance, and we can see frequently that this outlier hunting, letting profits run, trading hundreds of different markets in a pure trend way, if this doesn't outperform and do better and more robust, then what are we talking about? Then I'll admit that I'm 100% wrong. It was never about any of that. It was just do what you want to do, throw in what makes you happy into your systems, And as long as you're basically trend following, it's basic trend following. Vol management's fine, correlation management's fine, all this other stuff, trading markets differently, different parameters, different systems, whatever the hell you want to do, pursue your happiness, override robustness and strict rules and the back test. Then yeah, I'll be the first to admit that and agree that when you put them side by side, there looks to be no need to have these strict way of looking at the markets and trend following.
You and I have got to live for another 30 to 40 years, and then we can say, see, we told you so.
Yep. How are you today?
Hey, Jerry. Well, I'm busy. I'm busy, like crazy busy. Now I got 70 stocks, long, 70 stocks, short, 70 classic portfolio. So it's 200. So it's and I'm trying to get on with it. So really, and I think in an environment like this, a trend follower is usually not. We will not be complaining because I'm trying to. The only bad thing about this year is I've just started my systems in May, so I'm playing a little bit catch up with the equity markets, but not as much with the dollar. And so I think it's an excellent place to be in. These markets are just like trending like no other. So I think I just need to sit back and watch the dollar move. Right, the dollar is just moving, going down from 102 or 103 to God knows where, maybe 90, maybe 80, maybe even below that. And the equity bull market is just like, if you're trend following these stocks like I do, well, they are going up. So that's positive. And so my view is in any year, if there are two asset classes are making money, so that's a very good thing. It's not. So we're definitely not like like the beginning of the year. The beginning of the year was very tough. So there were losses. The credit trade was coming to an end. So there were back-to-back losses on those months. There were false breakouts in February with the equities, of course. So there are some losses coming from there while trading equity markets. And then March wasn't great either for credit trading. April was slow. But I say from May, from the end of the May, equity markets started to heat up for trend following. And now things are in motion. I think I'm trading fast, of course. And I'm thinking who are the other fast trend followers? I'm not the only one. I think EMC Brian Proctor. Him and I are mainly on the same trends. I would say. If you really listen what he was saying, those trends between 15 to 4 to 5 days his systems are, I think we are writing the same stuff with him. So and of course there's Nicole Collagen is there as well, right? He's a short-term trend follower. So there's a short-term market in short-term space. It's just we are not that popular. We're not that I would say not that common, but to be able to make money, things have to move. It has to move. And in an environment like this, I believe even the long-term traders will start trading the dollar, as Jerry Parker has mentioned. So, in a month or two, things will be starting to roll nicely, and hopefully we can finalize the year with a grace. Hopefully, thanks a lot.
Oh, I wanted to see if Seth wanted to talk. I wanted to speak last week on the trends in crypto, and I decided to dedicate a small create a new sector for my on my position portfolio crypto sector, and just kind of combine the Ether futures and Bitcoin futures with a handful of equities, and not anything too big. They the I think it's hard for me to really get to the bottom. I try to do some research, and I use AI to help me understand how these different companies are involved in blockchain and digital assets, and make sure I do get some um, actual companies that are actually doing that more of a pure way. But and some of them, of course, their charts look very similar to Bitcoin and Ether, and some of them don't. So, but I do think that this is a good thing to emphasize in a portfolio, to have a little bit of exposure to those futures and stocks in that industry. And the trend is higher, and it's really good. I'm happy to see that coming back. And it's just the perfect market for me slash a trend follower, because I have no idea what most of this is even about. I try to read up and understand it, but I did come to this conclusion that I do think that it would definitely be possible one of these days, and this would be a major uh, advance, to be offered the ability to pay for things like on Amazon in either dollars or Bitcoin. I think, wow, that would really be a big change and achievement, and earning interest on your safely, earning a normal amount of interest on your Bitcoin. Thank God, these are things that if I see these things happening, I'll really take more comfort in thinking this is something that's going to last for a long, long time, but it really needs to start looking like a currency, and allowing people to basically uh, choose how they want to invest: Swiss franc, euro, yen, dollar, Bitcoin.
Yeah, it's funny. If I think a lot of people were thinking all that was happening kind of back in, I guess, 2020 and 2021. You had all these companies coming out offering, high yield on your crypto balances, and so much of that stuff just completely blew up and was crushed by FTX and just the market, the bear market in general. And there still seems to be a lot of work going on around doing all that, but um, I don't know. I've kind of transitioned where it seems like the best place for cash is in an Interactive Brokers account where you're getting almost 5% interest, and it's protected, up to the government guarantees. And as far as the companies and the stocks around crypto, there's definitely a lot of them out there, from miners to exchanges, um, the crypto banks, but all of that stuff has just gotten so mired in um, regulatory issues now, and um, hopefully, if Bitcoin and Ethereum and some of these can start rallying again, it'll maybe bring some interest back and kind of start building the wave that started back, I guess, post COVID, which seemed like was the when all that was going so good. But Bitcoin and Ether futures are still kind of right around where I got long. I guess it was a couple of months ago now, and they kind of popped up and then faded back, and or I think really right around my break even point. So I'm hoping that it can get going. Maybe the dollar falling will help push those higher. And it's interesting too. crypto was rallying so hard with stocks a couple of years ago, and now the stock market's kind of taken off, and crypto is just kind of sitting still, even with the tailwind of maybe the dollar falling. So, like everything, we think things should affect things in certain ways, and in the end, the market does what it does, and that's why trend following is the best approach, right?
Hi,
That's
Jerry.
right. Yep. Hi.
Yeah, I
Michael,
think
I did want to I appreciate you being here. I did want to comment on one of your tweets, and I wanted to. I'm glad you're here because I thought we could have a good discussion on one of your tweets. And sorry to interrupt you, so keep going and see if you can guess which one I'm talking about.
my tweets are about sarcasm, Jerry. Don't pay any attention. Okay, I think there was a breakout yesterday in BTC futures, but this being used as a currency. Listen to this. The BTC futures have a 30-day annualized 365-day standard deviation of about 60%. And the mean since the inception is about 81%. So you cannot make this currency. It's impossible. The dollar index has a 7% annualized standard deviation. No one can handle this in their books, this standard deviation. Anyway, I just wanted to ask you, will your ETF be shortable?
That's a good question. That's funny. I don't know why not. I do a lot of shorting in stocks, of course, futures, but stocks are a little bit different ballgame, a little bit harder to do. And if you'll notice on the positions, I don't have any stock indexes, and I don't have any. I used to short some stock ETFs to get country exposure. But then I just said, heck with all that. I'm just going to commit myself to doing. I talk so poorly about these indices, and they're not really good trading vehicles at all. And intellectually, I cannot justify a stock index trading it in any way. So I trade these single stocks, and I'm very concerned, on liquidity. And then the borrowing charges of putting that stock on. And I limit my stock shorts to mega caps, which in some respects, they're easy to short. The fees are low. I think there's more potential in a short because it's bigger, more diversified. And, some of these that I'm short, they're good companies. Like I was on this podcast recently, and the guy was asking me, list some stocks that you're long and short. So I listed Oxy Petroleum that I was short. And I kind of did it just because I wanted to be funny. Because, Buffett had just come out about increasing his position in Occidental Petroleum. And I was like, well, look, I'm not going to shy away from it. It's in a downtrend. I sold the breakout. Buffett is long. I'm short. Let's just see who is going to win on this trade. And I'm perfectly okay with taking a small loss. And I just thought it was kind of funny and what could I gain by if Occidental Petroleum has a massive a downtrend for a year or two, it'd be kind of a funny story to tell. And I actually was short Berkshire over the past year because it made a downside breakout too. And of course, that was a losing trade. So I think shorting these stocks, it's you got to find the shares to borrow, and that can be difficult unless it's a really large company, and then you got to pay a lot sometimes to short it. Even at IB, some of the shorting fees will be pretty high for stocks that are illiquid and not very big. So it could be difficult to short in quantity. Could be difficult. So I don't know. I don't please don't short it. No, really, I don't care. It doesn't matter.
Well, my point is maybe I'm wrong, but this drive for trend following ETFs and replications, to me, it seems like a race to the bottom. Why am I saying this? The exchanges and the regulators now, they allow you to trade active ETFs. For what reason? I think it's good for passive investors because these ETFs will make the markets more efficient. If a lot of CTAs, they start issuing ETFs, in my mind, in my opinion, the trends will get rough, they will be arbitraged out, and the profits will be gone, and people will turn to the stock market. And then all these professors at the universities who talk about the EMH, they will say we won. So CTAs and managed futures, they started like an absolute returns niche market in the 80s, in the 90s. Then they became sort of capital preservation during the lost decade. And now everyone wants to make an ETF. Why? You had such a nice niche market. Why do you want to give vehicles to arbitrageurs to destroy it? That's my question.
I think that, okay, so I'm very prepared for that question because that's the first question I'm going to get from people who are in the business. So I have been preparing my answer for that. And let's see if I can remember it. I have it all written down, But so number one is I like that book, The Innovator's Dilemma. And part of what he says in there is you have to, in order to do something new and different, a lot of times large successful people cannot do things that are new and innovative because it will cost them too much money and hurt their current product. So in some respects, people see what's coming. They see it from a mile away. I can see what's coming, but I can't get involved in this because it will destroy my current business. So what it's left to is people who have nothing to lose. So I have nothing to lose. My ideas about trading and trend following have been blackballed and rejected. I have nothing to lose. I have small amounts of money under management. So why not? And this could be something that in 5 or 10 or 15 years, people would say, why didn't we all see that this ETF thing was going to destroy and overwhelm all of money management? And how long did 2 and 20 continue to last during a period where ETFs were coming out and were rampant, offering clients more liquidity, lower fees, transparency, and all the benefits of ETFs? And so I think number one is, why not? What am I going to do? I've raised more money in 2 days than I've raised in 2 years just by having an ETF. So, so that's number one. And then number two is this idea that when you do things like this and you on purpose set yourself up to make a lower fee than you've ever made before, then you're like, well, you're taking a chance and a risk that this thing could get very large. My biggest question I have, obviously, to myself now is, why didn't I do this 10 years ago or 5 years ago? Obviously, because I did it now. The only thing that would make it better is if I had 5 years under my belt. So, yeah, I don't really probably understand some of what you were saying as it relates to arbitrage, and maybe I'm not even addressing the points you were making. But yeah, I mean, just as a pure money management business, I'm not saying don't have a private fund. I still have my private fund. One of my jobs as a business person is to make that private fund have a reason for existing. There are a small, minor limitations to the portfolio contents of an ETF versus a private fund. And there are some ways you can tweak a private fund to make it survive and prosper at the same time you have an ETF. And there are some things I won't do, which is on purpose make the ETF worse in order to be able to tell clients like, oh, well, if you go to the ETF, you're just going to make less money. It's a worse product, but that's because it's 100 basis points.
Yes, I get where you're coming from, Jerry. I understand your points, but I'm talking in general. I mean, you may have no choice, but what's the difference with this AXS EQCHX fund from the ETF?
Oh, very good question. So that Chesapeake Mutual Fund has been around for a long time, 10 years, and it has a very good track record. And it is traded, well, number one, of course, the big difference is it's not an ETF. Number two is it was created and has been managed to fit in to the managed futures category. So it doesn't trade individual stocks. It trades indices only, and it doesn't trade 300 markets. It trades like 60 or 70. So it is on purpose designed to fit into the idea of what clients think about and want when they say, I want to buy managed futures mutual fund. And that is not heavily weighted in stocks, not 50%, like 20% stocks, not stocks really, stock indices. And not just the Chesapeake, we would never choose a worse way of trading in order to enhance the possibility of crisis alpha. In other words, the way to do that obviously would be to trade shorter term systems so you get short the indices quicker than a longer term system that it's going to have better performance, but we're going to sacrifice performance with shorter term trend following that gets short the S&P quicker. And so we would never do that, but it is built to sort of fit into the portfolio of long stocks, long bonds, allocate a little bit to managed futures, and it will not be overly weighted in equities because you already have your equities, but it'll you'll have some short equity exposure from indices when stocks go down. Hopefully, we'll be short before or shortly thereafter a big crisis like 2008 or COVID.
Hey, Jerry. Hey, everybody. Jerry, I have a question about the ETF in terms of taxes. Like, how do taxes get handled? So I'm assuming this company is trading your strategy as it is, and then at the end of the year or whatever, there will be taxes owed on the trading. How will that be reflected on the price of the ETF, and when?
Oh, I don't know how it impacts the price of the ETF. I don't think it would impact the price. I think, but each individual who invests is going to have a tax situation with the ETF. Now, they are, I'm not an expert in this, but I do know that ETFs are managed in a way to be maximally tax efficient. So, for instance, I think if we go in and we sell a stock and it has a capital gain, there may be a way to kind of not actually sell it but replace it with something else so you don't really recognize that gain. I mean, I really have no idea. I do know it's a big thing, the tax advantage, especially as it relates to mutual funds. Now, portfolio in general is a lot of stocks that are eligible for long-term capital gain. If you hold them for a year, our average holding period is about a year. So the long-term nature of some of these trends, it will kick off some long-term capital gain. And then the other part of the portfolio is futures, and that automatically, in most situations, gets that 60-40 long-term, short-term treatment, regardless of how long you hold it. So, but as far as it relates to just the ETF, I mean, I think that's why one of the reasons you're seeing so much conversion of mutual funds into ETFs is because of the tax treatment. Most people think that the tax treatment of ETFs is better, and there's more games that they can play, which is way out of my pay grade. I mean, I majored in accounting, but I'm like try to stay away from that stuff, and taxes especially. But yeah, that's probably a question for ChatGPT.
And I have another question. I noticed yesterday I took a look at the ETF trading. In terms of liquidity and the bid-offer spread, I noticed the spread is around 50 basis points now, like the bid-offer. So how do you anticipate the liquidity to go over time? Will it depend on the size of the assets, or like basically when somebody goes in and says, I want to buy the fund, is it most likely the other side of that trade to be the market maker, or there are also other traders who actually want to sell a previously bought one? Like in terms of percentage, do you get any statistics of who's trading, who are the entities trading your ETF?
I think we will get those statistics. I'm sure we will. Each ETF has to have a designated lead market maker who must commit to always making a market. Now, but other market makers can come in as well. And I noticed that when I was buying, there was also probably other people who just as a habit put offers and bids way up above and below the market, just maybe from a fat finger point of view. Someone hits the wrong number, they get filled, and so that's irritating. And then I think we were sort of expecting and been told that don't freak out initially with the bid offer. It'll narrow and get lower as we get the technology ramped up with all the positions on and real-time pricing. And so I think it's going to get better. I haven't noticed the 50 basis points. The past couple of days, I thought it was pretty small when I looked at it, but I haven't looked. It's just 9:33. So, but that's something we'll all be monitoring. And that's the big bugaboo. On one hand, one of the problems with making a market is it's potentially 300 positions, right? And so you've got to hedge in some way 300 different positions. And yet one of the benefits of it is that it's 300 positions. So even if you're not able to hedge them all, because white maize and sunflower seeds are closed in South Africa, probably difficult that it's going to make much of a difference anyways. It's really beautiful that, I used to sit around thinking like, I really want to create a fund that is like, doesn't stress me out so much, and I want to choose the leverage. I want to choose these systems. I want to tweak this portfolio. I posted this article about this trader new fund that was coming out that had 21 markets, and they were specifically selected to maximize diversification. And so I had that erroneous thinking in my head as well. Just find those perfect uncorrelated markets, and so you can just like relax. But what happened is that I just went crazy on adding all these markets and getting this vision that if you chose a great diversified basket of equities, you could have this portfolio that exploded into all of this diversification: long, short, stocks, bonds, currencies, commodities, crypto. And now I just have never had such good sleep. I tried to figure out a way to do this, and I kind of stumbled onto it. A lot of it was just encouragement from Clubhouse and Twitter Spaces, and Richard reigniting my knowledge, that I learned in 1983, and I just sort of used to obsess about was like add more markets. And I kind of knew when I got into that mentality that there was no way to do this except through adding a lot of equities. But then you had to be afraid that if you added equities, you could have a big monstrous sell-off where everything got crushed. But then, you've got to figure out how to put that portfolio together, and so that doesn't happen, and have some shorts on as well, and trade a moderate leverage. This is just the culmination of my sort of desire to have fun with trend following, not so much stress. And so when you have all these positions, and it would just take such a large trend for any of them to be able to contribute, you'd have to have this tremendous outlier. And it's not going to contribute that much because it's 1 out of 300 markets. Then in the same respect, to get crushed and lose a lot, you would have to have a lot of bad things happening all at once too. So I'm off the track.
So, do you expect the price of the ETF in real time to be very close to the real-time performance of the fund because of the market maker being here and adjusting so? Or do you think it's possible that the ETF could have a large premium or discount to the value of the fund itself, like some other ETFs, or actually not some other ETFs, but maybe not necessarily ETFs. I don't know how ETFs are actually structured or whether this is even possible. But would it be possible, for example, like there's this GBTC fund that was at 50% discount to Bitcoin. Now it's only down 27% discount. Most of the time it traded at a premium before. The premium was 20%, 30%. So, but there's no Bitcoin ETF. And I heard people were saying that when there is a Bitcoin ETF, then such discounts and premiums will be non-existent. So I'm assuming you expect that the ETF to be closely matching the performance of the strategy itself without any discounts or premiums.
Right. I'm not an expert, but I don't think the concept of premium and discount translates over to ETFs like it does what you're talking about. And I follow Bill Ackman's fund and Carl Icahn's fund, and they're kind of at it against each other. And then I've been following kind of funds like this for a long time. Marty Zweig had one when I was in my 20s, and it had sort of a permanent, at one point, discount and then kind of a premium. and people have done these type of fund managers have tried to get rid of that through, I think, primarily dividend plays, paying an extra large dividend in some way, and that could help get rid of discounts. And then, of course, this is the next stage, to graduate to. You create a fund like those guys have that people buy actual stock in, like a company, and you have permanent capital. I think we talked about this before. And so you just have a permanent, $5 billion capital. And if someone wants to liquidate, they have to sell their stock. It's like sell Microsoft, buy it, you sell it. And so this is not the way ETFs are structured, because if we have people redeeming, we actually will reduce our AUM and adjust the positions accordingly. So, and vice versa. So I think the answer to your question, though, is, once again, I'm not an expert. And it would be, for instance, that in an ETF, what's a scenario that can occur, let's say, would be a large bid offer, a bid offer difference that's large and not what people want to see. It's too large. However, in the middle of the bid offer is the exact value of the fund. So, there is no premium or discount. You just can't buy it without paying more or sell it without paying less, because the bid offer is too far away. No one is going to trade at that asset value of $25, let's say, because it's 24 bid, 26 offered, $1 over and under fair value. But calculating fair value, that's a piece of cake. It's just $25 and you can't get that trade off. I think that's how it works, more so. And that's a bad scenario. So that's not how we want it to work. But we have great partners and Lead Market Maker, and there are other market makers as well. So I think that's the struggle for all ETFs. And I think, as Michael was saying, you don't really. I think it's easy to buy, and for some reason, mutual funds. A lot of people who are my friends and family and relatives who are buying the ETF, they could have bought the stupid mutual fund, but for some reason, just buying this ETF is so easy. People prefer to do this, and one of the appeals of putting together an ETF is that all of a sudden everyone's interested, but it's probably not a trading vehicle like right now. Like I'm long a mortgage-backed ETF as a trend-following play, and I will buy it and sell it and go short and go long it. But there's other ETFs I might have in my personal account that I just will sit with, and hopefully, this is something you should plan to sit with because it's a great investment, and you like the way we do things, and it's trend following. I'm not saying it is a great investment. I'm saying that's what hopefully that's what they come in with, that attitude, but not something you want to day trade. So encouraging day trading, but we do want to have a good bid offer. And then I think that average spread is tracked on the website. I'm pretty sure that it is. Now, I bought some DBMF recently just to make sure that my account was set up to buy things like that and use margin, just because I wanted to get prepared in case I wanted to buy a new ETF and use margin. And so I bought DBMF, and it was 700 and some million AUM and only 14 markets for the Lead Market Maker to hedge, and it took me 2 seconds to get filled. So new ETFs take a while to get to that level.
Jerry, I have one more question, and then I'll stop. Jerry, so you mentioned you have a lead market maker. So, and I'm assuming, and you also mentioned there are other market makers. Can anybody just become a market maker for your ETF And in order for somebody to be a market maker, would you have to fully disclose your strategy and instruments to them so that they're able to completely replicate it on their systems and their machines so that they can track the fair value and the bid offer?
Very interesting question. Yeah, that's interesting. I don't know the rules. Like I was thinking myself, do I want to stand in there and get inside the bid offer sometimes? Like I want this thing to succeed, so I'm going to get in there and be a market maker. That's probably some sort of violation. I was just joking in the gym on my treadmill, just thinking about that, and if these guys can't do a good, keep a good market, and but I don't know if you're officially a market maker. You probably do have to register and follow some rules. But like I said, there are individuals who prey on fat fingers, and the first day of trading for hours, I know the value was $25, and I saw 25.17, and 24.90 is a bid offer, and it's probably people, small time people, just trying to rip off someone. But as far as real-time positions, that's a good question. I guess you would have to know those real-time positions. They must be out there somewhere. I only see end of day, but yeah, that would be a critical aspect for a real live market maker. Other than the lead market maker, they probably share all of those positions because everyone involved, even the lead market maker, is very interested in lots of people being interested in making markets.
Jerry, I can see the bids and asks as they stack up. Right now it's a 30-cent spread as I watch on my Fidelity Active Trader Pro. It's fun to see them, move around. Not a lot of volume or a lot of action, but 5,800 shares so far today.
Yeah, I mean, there's a lot of Twitter friends who are interested, and then once the word gets out that it's a unique product, people think bigger people will be interested. And I think I've looked at. I monitor sometimes the reports. I forgot the name of it now, but that show who owns what in stocks and ETFs. And I noticed that DBMF has some big investors, and I think another big advantage for everybody, for us and for the buyers, potential buyers, is one of the big advantages of an ETF versus, let's say, a private fund is the anonymity. Like, I don't want to talk to this guy. He talks too much. I just want to put some money in, be left alone. When I fire him, I just don't want to talk to him. I don't want to have to deal with it. Send the paperwork in, ask for redemption. No, I just want to sell it in my account, buy a bunch, sell a bunch. I don't want to be talked to. I don't want to be marketed. I want to be under the radar. And I think that's what I was seeing, that Andrew had some large investors, institutional type investors who it's just too easy to buy. Just throw it in there. It's not this big, huge decision. And we don't have to have a meeting. We don't have to have a big due diligence call. I see the positions. I heard what they have to say. If it doesn't line up, we're out. We'll just sell it. And so that's it's very efficient. It's very 21st century. Yeah, I don't know how we're going to lose. I mean, I don't want to be in someone else's shoes with 65 markets, watered down trend following at 2 and 20. I would not want to be in that situation. I imagine how I can possibly not win. And I think that I can possibly not win over the short term. I'm trading too many stocks that are going to bite me in the ass. But I'm not going to go. But I think there's so many other ways that I have shored up the potential for losing. I'm not going to have a lost decade due to stocks being the only thing that's moving, and the long-term trend following systems that are available to everyone, one entry, one exit, and a stop loss in the public domain. They suck at everything as far as volatility, profit give back, and rip your heart out, except on the back test, they have a tendency to make money more frequently than any other strategy. So I think that is what I'm hoping that kind of continues. So yeah, I'm very optimistic, very bullish on trend following, and it's so stupid that the whole thing is available. This is what makes it so appealing to so many people, is that you can look at a long-term track record and see success, and you can do it yourself. You can understand it yourself, or you can put the money in the ETF.
Jerry, what's your break-even AUM?
You know, setting these things up is pretty cheap. We were putting this thing together, and we kept telling our friends, we're going to do this ETF. And they were like, I don't think they were confident. They were kind of skeptical. And so at one point, one of them says, well, I guess this ETF is going to happen. And I'm like, what the fuck's wrong with you? Of course it's going to happen. All you need to do is have a little bit of money and pay a lawyer and sign up. And there are these ETF in a box companies that'll just do it all for you. And then you have your ETF. I mean, it's not like it's rocket science. It's not like it's hard or expensive. But, to trade a few $100 million, you've got to have good staff, good people, compliance, traders, researchers, computers, software, marketing. And so it's really has nothing really to do with the ETF. We have a budget that's pretty large in order to manage money responsibly, professionally. And so we need to raise some assets to pay those people and make some profit. So we've been running this budget for a while, and that's just what you have to do in order to be successful. And then the ETF is just itself incrementally, it didn't add a lot of expense. It just hopefully opens up the AUM and the potential to gather assets. And so it's just so much easier because I'll sit down in my spreadsheet and I'll say, okay, at hedge fund fees, which we charge 1 in 10, how much do we have to raise? And then at ETF fees, how much do we have to raise? And I'm just telling you, it's crazy, that number, right? And so you're like, okay, let's just forget about ETFs. Let's just raise money on this hedge fund. And you're like, well, it's a lot harder. And so, at some level, you multiply the fee times the AUM, and they start to even out. And so getting to $1 billion or $2 billion in an ETF is much easier, at least for me. I get no positive feedback. I don't have people telling me at all, quite the opposite. They tell me, no, you're not. You want to be in managed futures. You want to be a CTA. Do not trade stocks. No, do not trade classic trend following. Okay, this is the box that you put me in. I'm passionate. I'm going to do it. It's better. It's an achievement. It's moving forward. It's where it's going to go. I know it's going to go there because it's what's best for the client. Got to trend follow everything. You got to maximize the diversification. You got to let profits run. You got to quit being a wimp about volatility. And so it's going there. It's going to go there with me or without me. Eventually, what's best for the client will win out. It's America. It's capitalism. It's free men and women. This is what happens. It's cheaper. In America, in Europe, let's say, we don't get better stuff. We get better stuff for less money all the time. This is our way of life. And CTA is not immune to this. I know it's a bummer that 2 and 20 turned into 1 and 10. But if you add a bunch of crap to trend following, you can get back to maybe close to 2 and 20. I get it. I understand. But are we going to be shocked in 5 or 10 years that every CTA has this ETF wrapper, the best program they possibly can offer to clients, scrambling and doing their best to raise assets with the best trading systems that they've ever had, and being thankful for 100 basis points? I mean, I don't know if it's going to happen, but it could. And so,
yeah, I assume these authorized participants and market makers are not allowed to front run your positions, right?
Right. I would assume so too. They're probably not taking positions in the ETF. That might be one of the big rules. You can't really, yeah, not sure about that. Yeah, I'm not sure how it all works, honestly. My job is to produce the trades and get those trades in the hands of the traders so they can put those positions on, and then as those positions are going on, they are electronically being transmitted to the market makers so they know what that is in that basket. I call it a basket. So I'm doing my job, and the people that we're working with are many, many years of experience doing what they do. And I think they do a lot more things than just little tiny ETFs.
Good luck, Jay. I think you will do well with this, given your track record.
Oh, thank you, Michael. I did want to, at some point, maybe next week, we can talk about that one. I love reading your research, and I love that you are doing some research on trend following. But I will say that we do have one thing going on where I think from all my research, and this is where our research deviates a bit, what you've said and what my experience has been, and I'm sure it's easily explainable, but I do think that it is not, it is normal and for CTAs to have a win percentage of 40% thereabouts. I think if you have one, my guess is that if your win percentage is low, like lower than 40 or 39, that sort of thing, then it's going to be heavily determined by the size of your stop loss. So I think that, and I've tried to say over the years, like, I don't know if I should say that my stop loss is like is that I'm taking small losses. I don't think I'm taking necessarily small losses. And I know in your tweet you said, well, it's possible that if you have a win rate that high, you're not even using stop losses. So I've tested that as well. And so I think I do use stop losses, but it is a optimal stop loss, not too small, not too far away. But when we researched all of this many years ago, we noticed that the closer your stop loss was to the entry price, the lower the win rate. Obviously, yeah, and it's a fair trade-off, right? It's a fair trade-off. Now, I used to trade turtles were like 2 ATR, and some of the turtles were a quarter ATR. Yeah, quarter ATR. And then there's a break even at some level when you get out there 5, 6, 7 ATRs. The win rate doesn't go down any longer. It doesn't go up any longer. It just kind of stabilizes around that 40% level. So that's my analysis of it. So if you are now, I think another thing too, when people do research, and we've all done it, And even my friends, where we all started at the same place at the same time, as we get going down our research paths, we start having these different ways of describing things and doing things. And it's really difficult to debate these issues because we don't really know everything that the person is doing. And I'm sure if I looked at your code, I would say, oh, crap, I see what you're saying now. You're right, I'm wrong. Or if you looked at my code, you would say, oh, right, I didn't know about that. I didn't take that into consideration. So I think it's very difficult because we have this proprietary knowledge that we don't want to share. So when we get into these debates about backtesting, on Spaces, I don't think they've gone anywhere because no one's going to disclose or can even think about all the different things that goes into their coding and their assumptions. And it sounds like I'm coming up with way different ideas than other people, but it's just because of some of the givens that I've accepted that, I forgot to explain. I don't do things quite that way. And then maybe others who looked at that would say, well, I don't like your code because it's not robust, or it's not, I would never assume some of those things that you're assuming. So I do think it's sort of, most CTAs over the years, over my 39 years, they've all coalesced around this idea that the win rate is around 40%. But I know that it can't be lower, but it's usually, in my experience, due to tighter stops.
Yeah, I mean, just to add on to that, my systems have 40% as well, breakout systems. So, when Jerry Parker says that 40% is across his systems, it just makes sense to me as well. Thanks.
What's your maximum drawdown?
Well, the maximum, now I haven't tested it over 300 markets. And it's problematic. And I don't pay much attention to those type of equity stats as it relates to the drawdown and volatility. I have another way of doing it and measuring my risk and keeping my capital protected. And I don't really focus too much on the equity stats. And so thus I don't make it a high priority to figure out a way. A lot of my stocks that make up my portfolio, they haven't been around very long. And so I have to figure out a way to choose the correct systems to trade by not being able to backtest my portfolio. And so given all of that, I would make conservative assumptions historically and maybe not even include, so I'd sort of sabotage my results to a degree. So maybe I wouldn't even include single stocks. I would just put in stock futures, stock index futures, or I would just on purpose choose a bunch of old companies with a lot of data just to get an indication as to what it's going to look like, and fully expecting results to be, way much better if I can choose my own portfolio and add in stocks that would offer lots of diversification that haven't been around that long. My goal was just to achieve the best trading ideas and systems to trade, and thinking that all trades make the same amount of money. They have the same expectation. All markets have the same expectation. It's all the same. And as a placeholder, put in these stocks or put in these indices. Okay, so bottom line is, what we would come up with was the drawdown would be twice as large. The max drawdown is twice as large as the annual return. So if you make 20% annually, on average, 40% drawdown. And of course, we would say, okay, more than likely it's going to be worse than that. But at least on the back test, and I've heard this from other people too. Yep, that's my results as well. About 1 to 2 as the drawdown from peak. And then I don't pay attention to that. I don't care what the drawdown is from peak. I just care about preserving my capital the way I define it, the way Richard and I define it, and making 15 to 20% a year.
Yeah, now with the ATF, you have to watch out the drawdown. These investors are very nervous about it.
That's right. And I get encouragement from people to say, like on Twitter, they'll say, ramp it up, ramp it up. Why don't you show more vol? Why do ETFs and mutual funds don't have enough volatility? And I'm like, whoa, whoa, whoa. Yeah, okay. I tell you what you can do. Do what I did. Go into your IB account, buy the ETF, and they have margin available, And so everyone tweak their investment, deleverage it. If you have $1 million in your account, buy $500,000 of the ETF. Somebody else, you have $1 million in your account, buy $2 million, $3 million. I think you can get 6-to-1 leverage at IB. I'm not recommending that. I'm just saying, go ahead and do it for yourself. And I do it. Other people can do it. You can just deleverage, up leverage, whatever suits you. I need to sort of figure out what's going to appeal to most people who are not going to do that. And I think this, high teens, it's stable. You're not going to freak out, because I think that I really do appeal to people who love trend following. And it's a small group of people, and it's normal people, low net worth, high net worth, intellectual, not intellectual, traders, Wall Street types. It could be any kind of person. 1 out of 10, 1 out of 20 people might actually like trend following. That's what I'm going to appeal to. But if you trade so large and you make it so risky and the drawdown is 40%, that it's going to, really people, even if you love it, it can really be tough to hold. And so you have to, that's part of running a business is putting together the systems, the markets, the strategy. Oh yeah. And the leverage, so you don't freak people out and they hold on to it.
Well, I think most of these ETF investors, they tend to treat those vehicles as the same way as stocks. And I think my opinion is that 20% drawdown is the maximum they can withstand. Like DBMF, I think fell like, let me look here, fell like 20% this April from top. So I think that's the maximum.
Yeah, I'm not surprised. Not surprised. I think, I think that's probably the limit. I think that also with trend following, you need to, if you do it in a good classic way, you could possibly have the preceding 12 months be so great, like in Andrew's case. The preceding 12 months were so amazing that people are like, okay, yeah, I didn't like that drawdown, but, this is trend following. You make a lot, it's all open trade, and then you have this drawdown, and you get out of the trades, and you're still looking pretty decent over the past year or two. And I think that can mitigate a little bit of that as well. But I don't think it's like stocks in the sense that people are, if stocks go down, people want to buy the dip. And with this active trading of futures contracts and trend following, they're like, oh my God, this thing's never coming back. So I wish it was more like stocks. And I think after a lost decade of equities, let's say, if we get back to a situation like we had when I was in the 90s and early 2000s, where the presentations that would show that CTA diversified trend following made more money than the S&P and had lower drawdowns, we get to a decade of that, then we can get people to rightfully buy those dips. Because when a stock in my portfolio dips, I'm not buying it. And you shouldn't be either. But when my fund dips, you should definitely, or when trend following funds dip, you can definitely buy those because they're not internally buying those dips. They're doing trend. They're maybe shorting that dip. So a whole different ball game. Expectation, mathematically wise, it's much better to buy dips and trend following than it is in individual markets.
I have mentioned that people don't like most these drawdowns from the peak to valleys. But in fact, buy and hold strategy looks not better, it looks worse. So our system, our trend following system, looks better than buy and hold. So, as I have said before, we must educate people more that it's our strength, I think. Because not people, a lot of people don't understand why we handle this drawdown, why we don't close our trades.
Okay, I'm off to do 2 more podcasts today. Hopefully, Mike and I will do ours in a few minutes, and then I will do RCM podcast later, and we will undoubtedly get into some of these same topics. And this has been fun. Thank you to everybody for tremendous support and encouragement. And hold me accountable. Hold my feet to the fire. Don't let me get away with crap. I don't want to operate that way. If you see me deviating, getting off message, changing, oh God, I listen to some of these old podcasts. People quote me. I'm like, man, I have not said anything new and interesting in a long, long time. But that's good. That's better than changing. Too much change. A lot of my change has been correcting my changes. Like, oh, I shouldn't have done that. I should revert back to what I learned in 1983, but with just longer term look backs. Sad. What a sad state that is. But I do smile when I say that because it is kind of interesting. I learned from geniuses once in a million year opportunity, and it was so. All right, have a good weekend. See you next week.